OSFI is about to bring the pain. That's right, the Office of the Superintendent of Financial Institutions has set forward with consultations that are about to make getting a mortgage in Canada significantly more difficult. And if you think the stress test was bad, well, this is about to get a whole lot worse. Assuming, of course, that stakeholders allow OSFI to follow through with the proposed new guidelines. And I'm going to tell you right now that at a time when the stress test is being questioned as still valid, these new rules take it a whole step further than what the stress tests ever intended. But before we get into it, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So go ahead and click that subscribe button and hit that like button so more people like you can see this video. And I'm not sure if there'll be any left by the time this gets published and by the time you see it, but there is a chance that there still may be copies of my new book available for free at mortgagesecrets.ca. That's right, I'm giving away 500 copies of my brand new book. All you have to do is pay shipping and handling. Just go to mortgagesecrets.ca. Okay, so let's get into it. Let's discuss what's going on with OSFI, the Office for the Superintendent of Financial Institutions. This is the organization that regulates the banks and more specifically uninsured mortgages. For those of you who've been following the channel for a while, you will know that insured mortgages are typically regulated by the finance minister through the Department of Finance. But for uninsured mortgages, OSFI is where the buck stops. And as quickly as OSFI announced that they were reviewing the rules with respect to uninsured mortgages, they released in a consultation paper the proposed new rules that could go into effect as early as end of April or May of this year. So as we like to do on this channel, I'm going to make this as simple as possible to understand. I'm going to jump you into the document and I'm going to highlight the most important pieces here. So let's start by taking a look at the briefing and more importantly, the suggested changes they're about to make. Now, there's three specific things they have outlined here. They've outlined loan to income and debt to income restrictions. Now, the good news is they aren't at this point suggesting debt to income restrictions, which I'll get to in a second. They're suggesting debt service coverage restrictions, and they're suggesting interest rate affordability stress tests that go beyond the existing stress test. So let's start first with loan to income and debt to income restrictions. Now, there's two ways that this can be looked at: loan to income and debt to income restrictions. Now, loan to income is when the loan that you are being given can only be a certain multiple of the amount of income that you make. Now, this was seen widely in the very unsuccessful home buyer incentive plan that the federal government launched a few years ago, which was one of the most unsuccessful mortgage-related programs in Canada's history. And the reason why is because you could only borrow 4 times your income amount, which meant that you qualified for significantly less than what you would qualify under normal stress test guidelines. So when people asked about that program and said, "Hey, I'm interested in it," and you told them, "Well, sure, but you only qualify for $300,000 rather than $400,000, they instantly went, "You know what? Not interested." Well, what this is suggesting is that for uninsured mortgages, they are taking a look at doing exactly this, putting a 4.5 times limit on the amount of the loan that you can get compared to your income. And that could have a pretty significant impact on the amount of money that you can borrow. In fact, in all likelihood, it would reduce the amount of money that you could borrow quite significantly. Now, one thing to watch out for here before I get into a little bit more detail on this is that OSFI and the federal government tend to work hand in hand on insured and uninsured mortgages. So if there are major changes to happen to uninsured mortgages, there is a chance that these could flow through to insured mortgages as well, which would, like I said earlier, be absolutely devastating for home buyers and for people who are looking to borrow money for a mortgage. And if you put 2 and 2 together, you could figure out that this could probably have a pretty big impact on home values as well. And it's clear that in this case that OSFI is not concerned with home values, they are concerned with the financial risk in the economy and lending going forward. Now, the good news here is it doesn't look like they're looking at debt to income restrictions, which means that you will still be able to buy multiple properties and investment properties under these new proposed guidelines. And they aren't just looking at this for individual borrowers, they may look at putting in limits for lenders and allowing lenders to have a certain proportion of their business that would be allowed to exceed the proposed guidelines, which means if you're a highly qualified buyer and a really good client of the bank, you may be able to get a higher mortgage than somebody else who isn't necessarily a well-qualified buyer or a really great client of the bank. So good news, bad news, depending on which situation you're in. Now, the next thing that they're looking at is further debt service coverage restrictions. Now, currently, if you're getting an insured mortgage, you can only qualify at 39% GDS and 44% TDS. That is written into the law. So in other words, 39% of your income can go towards your housing expenses. 44% can go to all of your debt. And while this is more of a relaxed rule than what was available in, let's say, 2006, it is still a pretty restrictive rule, especially when you add in the stress test. But this rule hasn't necessarily been there for uninsured mortgages, which has allowed banks to, in the case of really well qualified borrowers or people who may be at a higher net worth, basically be able to do what's called debt servicing exceptions, which allowed them to lend to people who didn't necessarily have the income to support their debts, but had net worth or other supporting factors that allowed them to get a bigger mortgage than what they would otherwise qualify for. Well, OSFI is looking at putting in limitations for this, and again, only allowing lenders to exceed these debt servicing ratios in a certain number of files per year. Now, the third thing that they're looking at is doing interest rate affordability stress tests, which are different than the current stress tests and apply different stress test rules to mortgages that are deemed more risky. Now, this would include, according to the OSFI paper, things like variable rate mortgages, adjustable rate mortgages, and shorter term mortgages that have renewal risk. Now, the one thing that I really don't like about this dismisses the fact that there's incredible payout penalty risk for borrowers who get into a 5-year fixed mortgage, because in this paper, OSFI is suggesting that a 5-year fixed or a 10-year fixed mortgage is less risky than a variable or an adjustable rate mortgage. And that's not necessarily true, because if you have somebody, for example, who finds themselves in a situation where they have a 5-year fixed mortgage and maybe their property value isn't quite as high because OSFI went and put in a whole bunch of rules like this, and they have a mortgage with a big bank and interest rates have gone down slightly, they could have payout penalty risk that causes them to lose a significant amount of their equity to the bank in order to break those mortgages. So suggesting that variable rate and adjustable rate and short-term rate mortgages be stress tested at a higher rate ignores the fact that there are other risks that come with fixed rate mortgages. And this is my biggest concern of all of these rules, because they're allowing exceptions for the first two, which were limits on loan to income amount and debt servicing ratios. But with respect to the stress test piece, they're looking at certain types of mortgages and they're ignoring certain types of risks that are probably going to be a news story in the next 3 to 5 years, while looking at other types of risk, which are things like rising interest rates, and deeming those more risky than the others. And there's risk involved with both fixed and variable rate type mortgages. And it's arguable that the reason that a lot of people took variable rate mortgages over the last couple of years was not because they thought they were going to win on the interest rate game, but because they were afraid of those fixed rate penalties that had come back to haunt so many people. And by the way, these fixed rate penalties are significantly more expensive if you are at a big bank, which, by the way, is the primary people who are going to be providing feedback on these rules. Now, lenders like CMLS, lenders like First National and MCAP, these are all OSFI regulated lenders when they're doing uninsured mortgages, but the majority of the uninsured mortgages in Canada are done by the big banks, which means they're going to have the biggest voice here, which means it is in the majority of the people who are providing feedback's best interest to have variable rate and short-term mortgages stress test at higher interest rates to encourage people to go into fixed rate mortgages, which, by the way, are the single most profitable mortgages for the bank, because they win by charging a higher premium up front, and then they win again by having a premium on the penalty. So if the banks are given the option of saying, hey, do you want to stress test those variable and those less profitable mortgages more than what the fixed rate mortgages, which are more profitable, are stress test at, what do you think they're going to say? They're absolutely going to suggest that it is a good idea to do that, and it's absolutely not. So that is my big concern with the risk going forward on this. Now, this has major implications for the Canadian real estate market. I'm going to link to a video right here that talks about those from a couple of days ago. Believe it or not, and for those of you who've been following this channel for some time and believe I make predictions, well, I typically don't, but I did make a prediction that the loan to income limit was going to be something that they look at. And you can check out the potential repercussions for the Canadian real estate market in that video there.